Welcome to the Let's Get Entrepreneurial podcast, your go-to resource for navigating the world of entrepreneurship.
Dive into the dynamic lexicon of entrepreneurship in this episode, where we decode the jargon and buzzwords that every founder needs to know. We unravel terms that map the entrepreneur's journey and power the startup ecosystem. Join us as we demystify the language of marketing, finance, and business, providing clarity and insight to both aspiring moguls and seasoned magnates alike.
The Let's Get Entrepreneurial podcast is your ultimate launchpad for igniting ideas and skyrocketing your entrepreneurial dreams. Tune in, buckle up, and let's unleash the entrepreneurial spirit within. Your two hosts will be Professor Gary Palin and serial entrepreneur Ryan Budden.
Hello, Ryan. How are you doing today?
I'm doing brilliantly. What about you?
Oh, having a good day. Everything's going well.
Glad to hear it.
Ryan, today I wanted to speak about something a little bit different, and we're actually going to do 3 successive episodes on this, and that's the Lexicon of Entrepreneurship, the various verbiage that goes associated with entrepreneurship. As with any activity, there's always terminology that becomes part of the parlance of that venue. Say, for example, if you're talking chess, you might be talking Queen's Gambit would be a term that not everyone would use. If you're talking basketball, then a pick and roll might be something that is used that people that aren't familiar with it will have no idea what you're using. Now, if you're talking crocheting, I'm going to rely on you to come up with an example of a crocheting term.
Yeah, the duck and weave, I have no idea.
Verbiage gets used in any particular type of genre that you're in. In entrepreneurship, we tend to use various terms, and both you and I are so embedded in this, they just roll off our tongue, and we don't realize that it's just to the specific area of entrepreneurship, and someone that's not as familiar with it, they won't know what the heck we're talking about.
Absolutely. And just understanding the vernacular or lexicon that are common in the entrepreneurship world can make you seem like an insider. So it can give this feeling of comfortability or mastery that maybe you don't quite have yet.
Absolutely. So when you're going to networking events, you can follow along with the flow of that. I'm not recommending that someone just throws jargon out there, because that's also very obvious and very fake, and people will catch on to you.
They will.
There are hundreds of them. So we decided to break them up into 3 categories. This episode is going to be about finance terms. The second one will be about marketing terms. And the third one will be about general terms that are used in entrepreneurship. We picked the top 12 we feel are being used. There are hundreds we could go with each particular area. As a matter of fact, what I'm going to do is in the description, I'm going to list the terms and definitions that we're talking about in this and other episodes, but I'm going to also in the description put other ones that we're not talking about.
A quick cheat sheet for our listeners.
Exactly. So the first term I wanted to talk about was the term return on investment. And it's very commonly used, also referred to as ROI, and it's a performance measure that evaluates the efficiency of an investment.
So if you put $10 into something and you're getting $1 back a month, you can calculate a return on investment.
Exactly. And return on investment is a very important number when you're talking to investors.
It is, because that's what they're concerned about. How much money are they putting in, and what's the period in which they're getting it back?
They're in this for the game of making a profit. Now, you might have different people have different perspectives. Some like to be in the game, but you start getting into venture capital, they want to know what the ROI is, because people putting investments into their venture fund want to know what the ROI is.
And having a basic understanding of that can help you position yourself favorably.
I just fell victim to using verbiage that might not be familiar with people. I just said venture capital. That would be the second term we should talk about. Venture capital is a financing that investors provide to startups that are believed to have long growth potential. And with venture capital, I'll throw this third term in, angel investor, involved with this. They also invest in startups. But a major difference is the angel investor, for the most part, is investing their own money. They tend to be affluent individuals that are investing, where a venture capitalist, they pull resources from many areas, sometimes from wealthy investors, sometimes from institutions, to pull a venture fund, and they're investing that fund. They might have some of their money into it, but it's typically not their money.
They are a professional at investing money.
Exactly. And so there's two terms, venture capital and angel investors, and they have totally different mindsets also when you're dealing with an angel investor versus a venture capitalist typically.
Yeah, and I think we've actually done an episode if anyone's interested in more of the nuances of funding sources.
That leads us to the fourth term is bootstrapping. And that's starting a business without external capital or investment, and you're relying solely on personal finances and initial sales revenues to drive the venture.
You're basically starting your business and hoping for the snowball effect, that you'll start pushing it and a small amount of income will continue to grow and grow to the point where you don't need to ask somebody for funding to get over any of the hurdles that come up in day-to-day business.
In those three terms, that's typically the flow. Not always, there's always exceptions, but typically you'll see someone starting with bootstrapping, move to angel investors, and then maybe move to venture capital. You and I are a big fan of bootstrapping because you're retaining 100% equity and control.
Right. And we've done this enough before to know how to get over some of the hurdles that are very difficult to get over the first time you're in entrepreneurship.
People make a mistake very often of jumping to, let's get an investor right away, versus making an analysis, do you need an investor right away?
That's exactly right.
And of those three, when you're dealing with angel investors and venture capital, the early money is the most expensive because it's at the highest risk.
A lot of times it's at the idea phase. Before anything's really been executed, there's oftentimes a burden to get that off the ground. A lot of times entrepreneurs don't have that themselves, so they need to go get that from somebody.
Another term that's commonly used is seed capital, and that's the initial capital used to start a business.
It's the very first money in the door to get the idea from your brain out into the world.
Flowing with that, another term that's very often used, and I saw this during the dot-com craziness, is burn rate. That's the rate at which a new company spends its venture capital or angel funding to finance overhead before generating positive cash flow from the operations. It's interesting with the term burn rate is I don't think you lived through the craziness of the dot-com era. Is that correct?
I was a child during it, so I was definitely not in the investment mindset.
That was so fascinating to me because burn rate, you're trying to minimize your burn rate today. You want to spend as little money as possible while still moving the business forward. But burn rate was a bragging component during that time. People would be bragging about how much cash they're burning through at the initial onset of that. It was craziness.
Yeah, that's wild, isn't it? It goes in the total reverse of what you think would be smart fiscal money management.
And it shows you can get sucked into the mania of an issue. During that dot-com craze, people thought the rules were being rewritten for business. Burn rate is an example of that. And I was trying to make sense of logic, and people were telling me I didn't know what I was talking about. It turns out I was right.
Fancy that.
They weren't interested in cash flow. They wanted to know what their burn rate was.
And I think investors were attracted to that. It was the excitement. If you were burning a lot of capital, therefore you were doing a lot of things. And supposedly that had a positive outcome.
That's not the first time there's been mania like that. Did you ever hear of the tulip investment craze? I believe it was in Holland, I don't know, 16th century or so. That was a mania, people investing in tulips.
A similar thing happened in pineapples. They were the exotic fruit, and they got so expensive, people were renting them for parties.
I remember when there was a craze for purchasing ostrich eggs.
Oh, wow. Okay.
People had ostrich farms, but the real money was selling the eggs to people that wanted to create ostrich farms.
Oh, that's funny.
Crazy.
For those who aspire to go higher in their entrepreneurial journey, we've got something just for you. Coming up next.
Are you ready to unlock your entrepreneurial potential? Introducing the Janus Entrepreneurial Report, your personalized roadmap to success. In just minutes, discover your unique strengths and areas for growth. Whether you're a seasoned business pro or just starting out, the Janus Entrepreneurial Report will help you identify and leverage your entrepreneurial tendencies. Don't wait, visit Prosperit.com and start your journey to success today.
Now, let's dive back into our journey of entrepreneurial insights.
Crowdfunding. I've been giving the definitions. You want to throw your thoughts on the definition of crowdfunding?
Sure. So crowdfunding is the practice of funding a project or venture by raising money from large number of people, typically via the internet. So essentially, instead of going to one person for $100, you're going to 100 people for $1.
That's an area that's interesting too. I see a lot of people using crowdfunding, but very often it becomes pre-sales versus investment.
That's right. You've seen pre-sales in the investment realm come up quite a lot. So instead of, hey, this is a great idea, you're actually buying a unit at a subsidized cost once the company can create it. And I think there's a big emphasis on that through the crowdfunding platforms that have become really popular as well.
Crowdfunding is an area that I haven't played a lot with, but you have to be careful if you're going into crowdfunding. And I'm still waiting for the SEC to look at this.
Right. We've heard some pretty famous examples of crowdfunding companies raising quite a lot of money and then not executing. And you wonder, did they genuinely fail in their best attempt? Or was this a get rich quick for the founders?
Next term is equity financing. So what are your thoughts on equity financing? What is it?
Equity financing is the process of raising capital through the sale of shares. So a share being a part of the company, whether it's a percentage or however you're splitting it up.
And that goes back to our original terms, venture capital, angel investors, and bootstrapping. So with venture capital and angel, you're giving up a percentage of the business. And that's what equity financing is.
And we referenced it being expensive. So what we mean by expensive is the earlier they are and closer to the idea generation, the more of the company they're going to expect. So the more equity they're going to expect in return for their money.
With bootstrapping, you're retaining 100% equity.
That's right.
A lot of people make the mistake of thinking that angels and venture capitalists are loaning money. They are not loaning money. They're getting a percentage of the business and very often a seat on your board of directors.
Right. There can be many things that are snuck in the negotiation table, that's for sure.
Yes, which is why I like bootstrapping. Okay, cash flow positive. What the heck does cash flow positive mean?
Cash flow positive means when a company's cash inflows exceeds its cash outflows. So essentially, it's making more money than it's spending.
More money has to come in than goes out.
That's exactly right. And this is a big milestone for entrepreneurial ventures. You reach a point where you're cash flow positive.
Versus the other side, cash flow negative.
Right. And then you're in a burn rate scenario. So you're calculating how much money you're losing and how quickly you're losing it.
When I'm looking at creating a venture from the onset, when I'm doing the projections with the spreadsheets, I try to come up with obviously realistic expectations, which is a struggle unto itself. At the bottom line of each month, it's always a negative cash flow. And I look at the lowest point. What's the lowest cash flow I have in that spreadsheet? And that tells me how much money I need to bring in from outside investors to bring that to not to a zero, but I want to go above that to allow wiggle room. But that cash flow projections can help you to manage your cash flow.
And know how quickly you need it. If it's $10,000 a month over 2 years, that's very different than $240,000 over 2 months.
Another term, cap table, CAP table. What is that?
A cap table is a spreadsheet or table that shows the ownership structure of the company, including shares held by equity owners, investors, and shareholders. So it's who owns the company, how much they own of it, and it's used often to determine voting rights and who gets a say in what.
Yeah, and I like it because it's a very quick visual of where's the ownership.
That's important for everybody to know where they stand.
That's not a term that's commonly used when people are talking about startups when they're in networking functions, but you get into the nitty-gritty of financing, you can be assured cap table's coming up.
And everybody has to have a really clear understanding of where that cap table is and how it's going to shift based on an investment.
Initial public offering, usually referred to as an IPO, is the first sale of stock by a company to the public.
And an exciting day, I think, in a lot of companies' life cycle.
Yeah, it's a scary day too.
Yeah, absolutely. But you do hear a lot about this in the media, unicorns or fast scaling entrepreneurial businesses IPOing.
Basically, they're listed on one of the common stock exchanges where anyone can go buy a share of stock with that company.
And they've just opened themselves up to a world of reporting.
As I mentioned, the SEC Security Exchange Commission gets involved and you have to do annual reports and all types of fun stuff.
Exactly.
Very often that's when you move from an entrepreneurial venture to a corporate management business.
Yeah, it's definitely a different level of expertise.
And many founders get out at that point or are not as actively involved because it's a totally different skill sets.
Absolutely.
And then they become serial entrepreneurs and go back to starting another business.
Or they make enough cash that they never have to do anything again.
Yeah, but you can only play so much golf, Ryan.
Yeah, that's true. That's very true.
I can't tell you how many individuals I've met that cashed out very successfully and said, I'm just going to play golf every day. And I'll see them 3 months later and they're looking to get involved in another startup.
Yeah. Those are the people that should be involved in it. They're the ones that really have a passion for creation. They're not just in it for the quick money. And ultimately, I think those are the people that stick around for the long haul.
So if you're looking for investors, maybe a local private country club is the place to go.
Yeah, I think there'd probably be some truth to that.
The last term I wanted to mention was market capitalization. So what is market capitalization?
It's the total dollar market value of a company's outstanding shares. If you added up all of the shares that people own, what's that big sum of money? What does it add up to?
I can remember a company, I won't mention the name. It was during, again, the dot-com craze, but they went IPO and they owned nothing. It was in an arena where they didn't even own all of the IP because it was public domain. And their market cap, it was a mania. They were 10 times above the market cap in the local utility company, which owned a tremendous amount of assets. And I remember speaking to the CEO. I said, wow, I says, someone's going to be upset when that market cap catches up and your stock value goes down. And he told me, he says, I lose sleep over that already.
I'm sure. How could you not if you're in that situation?
Market cap is interesting, but there's the volatility of that with the market. It's just a fascinating field. We could do a whole podcast episode about market caps. We're wrapping up because we've covered 12, but there's one I want to throw in as an extra bonus, and that's hockey stick growth. What is hockey stick growth?
Hockey stick growth is when you have an inflection point. So instead of growing at a slow rate, you get the check mark or the hockey stick of rapid growth from that point on.
I swear 9 out of 10 startups, when they send their finances to me, they have hockey stick growth in their financials. And that's always a sign that they don't know what the heck they're talking about.
That's funny. Everyone wants to show that it's typically referred to as an inflection point because that's what investors are looking for. They want to get in at the beginning of a major inflection point.
Yes. And they will purposely force their finances that there'll be growth for a few months. And then all of a sudden, boom, they're going off the charts and it skyrockets up. Henceforth, why it looks like a hockey stick.
Correct.
That sounds good. Any final thoughts on the concept of the Lexicon of Entrepreneurship before we conclude?
I just hope that our listeners get some value out of learning the terms of an insider, right? How they can fit in and understand the conversation flows for the industry that they're becoming a part of.
Absolutely. And again, I will be putting some terms, the ones we spoke about and others, in the description if anyone wants to peruse those.
Fantastic.
Well, let's get entrepreneurial.
Let's get entrepreneurial.
As we wrap up another episode of the Let's Get Entrepreneurial podcast, we extend our gratitude for your presence and attention. Your dedication to the entrepreneurial spirit fuels our passion for creating this podcast. Check out profspirit.com to discover resources and courses designed specifically for innovators like you. Stay on the cutting edge by following us on Spotify, Apple Podcast, YouTube, and other platforms as it is released. Until then, keep the entrepreneurial flame burning.